Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. We appreciate you joining us today here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Nolan Baker and Dave Ross and myself. My name is Chris Swan. 419-794-3030 is the phone number. Once again, 419-794-3030, online arhq.com. Today on the show, with the Fed cutting interest rates, is it time to think about protection? We're going to talk about when to sell your home before retiring. What can you do now ahead of your end-of-year review with your advisor? All this and more, but before we dive into any of it, let me check in. Dave, Nolan, glad to be with you for another week. How are we doing today?
Hey, doing really good. I think the message is, for me, it's a lot of first and a lot of last coming up. So we just celebrated our last parade event with the Anthony Wayne High School hockey team and Boy Scouts. I've been doing the parade ever since my kids have been really little, so we drove our kids around in the parade. My youngest son for the last time as he's a senior at Anthony Wayne. And this month, during the month of October, will be his last official scout camp out before he finishes becoming an Eagle Scout. So a lot of laughs, but then that creates a lot of new firsts that are coming up too. So I'm looking forward to maybe the first day of college for him and the first day of the new experience on what he has.
I also have a senior, and she is participating in her last season of high school tennis. And it's tournament time. Last week was the league tournament. Now we're into the state playoffs. And so that's certainly an exciting time. And we're trying to get her to make a decision on where she wants to go to school. So hopefully once all this tennis business is over, we can focus on that and start moving toward it. So kind of in the same boat as Nolan in that regard.
Very big decision to make, a lot of milestones to celebrate and remember. And first and last, Nolan, we've talked about this off the air before. My son, his first camping trip is actually coming up later this month with the Cub Scouts. So I'm probably going to lean on you for some pointers because it's been a little while for me. But when it comes to these big milestones, these big changes in life, knowing that they're coming is one thing, preparing for them is another. And when it comes to retirement, arguably one of the biggest changes that, those listening right now, the retirees and pre-retirees are going to make, prepping for that. That's really what we're here for, to get you prepared for this next great chapter, this next great journey, and all the firsts you're going to be doing in retirement. That all begins with setting up a time with Speak to the Guys and, that retirement team action plan. You could do that by going to the website, arhq.com, or give a call. Like I said, 419-794-3030. All eyes are on the election coming up. It's a month away, and some investors are actually getting jittery over whether the outcome will impact the stock market. There's a study by T. Rowe Price that found from 1927 to 2023, the S&P 500 performed this way. Presidential election years, 11%. That's 24 observances, by the way. Non-presidential election years, the other 72 years, 11.6%. All years total, that's 11.5%. So the S&P average was up around 11%, elections or not. And what's more, markets typically see less volatility during election cycles. So should we depend on history when it comes to looking at elections, especially this election? What are you telling clients that are maybe calling up a little concern right now?
Well, I mean, I can completely understand their concern, with the election this year. I do think probably one of the most dangerous things that I can hear from somebody say is this time it's different. I can think of a situation where I was doing an event. I had a gentleman who came in after a workshop and had let me know about 2 years ago that he had moved all of his money out of the market just because he was really frustrated with this current administration, and he was going to, sit it out in cash until the election was over, meaning that he was going to wait for this 2-year time frame. And the unfortunate thing looking back is that the last 2 years he missed out on incredible opportunities because the market has had strong growth these last 2 years. And so, thinking this time is different is something very dangerous. In fact, if we look at the markets in whole, we've had really two back-to-back positive years in the market. This year's not over with, as well. But using history as a guideline, S&P has experienced roughly 15 positive periods where it's had 3 or more consecutive positive gains when you look at the history. So, history doesn't always repeat itself, but it's not saying that next year is going to necessarily be a bad year in the market. There's multi-year positive streaks that are common during, bull markets. You've got the longest span I think of in the 9 years from 1991 to 1999. Another streak that we had was from 2003 and 2007. The thing that I would say is that, though, when you look at market corrections, and so you look at COVID or 2008, or you look at most of these other market cycles, losses can happen fast in the market, and it's usually something that's unexpected that comes up. So with the markets at record high, don't worry so much about the election. I would say just make sure that you have a downside risk management system in place. It may not be a bad idea to protect some of the profits that you've had if you've had some strong growth in the market, and don't lose sight of your long-term goals. So I would say history in election cycles doesn't mean a whole lot for market returns, is my opinion.
Well, I would add to that, the Federal Reserve is starting to cut interest rates, which generally means that the markets respond positively to interest rate cuts. And I know one of the topics for today is, when do you sell your home in retirement? Well, has it been good for a person to want to buy a home in the last 12 months? Interest rates have been fairly high. So I think the cutting of interest rates are going to make more people consider borrowing. It's also going to get investment capital flowing, maybe more so into the stock market, because the election cycle, those 11 to 11.5% numbers are real. And so you want to keep your options open. But I would also say that this is a main reason why you need a qualified financial advisor as a part of your team, because we can have meaningful discussions about how to look at your investments and what do we do when the market takes an unexpected tumble. Because a lot of times it's not about when to get out of the market. It's, if you get out, when do you get back in? And a lot of people from 2008 never got back in. And that makes those losses permanent.
It does actualize those losses, and it compounds, between the market being down and then, the potential loss when the market does rally and go back up. Here is the thing. Over the course of your retirement, you're going to see multiple elections. You're probably going to see a couple market pullbacks, and you're going to see all sorts of different wild cards that could give you a little bit of pause. Now, we are an emotional species. Feelings are valid, but if you have a plan in place that says, yes, I know that these things are going to happen, but we've accounted for it thanks to something like the Retirement Team Action Plan, it can hopefully give you a little bit more confidence so that where you can tune out that financial noise, tune out that political noise, and be able to, a novel thought, I think, enjoy your retirement. But you have to take those first steps and set up a time to speak with someone like the team at America's Retirement Headquarters. Start developing that Retirement Team Action Plan. 419-794-3030 is how you begin. That's 419-794-3030. Or you can go to the website, which is arhq.com. Now, there is a famous saying out there, 3 words. It's actually just one word repeated: location, location, location. If you had a business and you were trying to figure out where to locate it, you should probably consider taxes. Shark Tank's Kevin O'Leary was shopping for a place to put his new data center, and he had to cross the state of New York. Well, he crossed it off his list.
The fine people of New York should ask themselves, why are we such a loser state? How are we going to attract business? It's not just the existing businesses that are fleeing out to Texas and Florida. What about new money like that I'm talking about, like a $4 billion data center? Not a chance I would put that in New York. Zero probability. Never.
Now, let's look bigger picture here. Let's think of your retirement as a business. From a tax perspective, retirement accounts are often the largest debt that an account owner has. Where you live and how to reduce those taxes, also important. How do you guys help out with that?
Well, I think his example of a business in the state of New York is a perfect example. I can think of at least two friends of mine that are financial advisors that used to live in New York. They both now live in the sunny state of Florida. So when you think about retirement accounts, you have to realize that retirement accounts are actually one of the biggest, if not the biggest debt that somebody owes. You know, if you had a business partner and that business partner, you owed a percentage of what your business was worth, and that business partner also had the right to say in the future that they deserve more, and you had little to no control of that, the question becomes, how fast would you want to get rid of and buy out that business partner? And, you know, retirement accounts are about the only account that I can think of that people choose to defer taxes to later in life. And the concern is if you're successful in investing, your account balance will grow to be a bigger value than it is today. In addition to that, because of the out of control spending that Washington has done, they've left us in this massive debt problem with unfunded liabilities like Medicare, Social Security, the prescription drug. Our national debt is now the highest it's ever been and continues to go higher and higher. So tax rates are, in my opinion, likely to be higher, especially for those that were successful in saving and investing into their future. So when you look at retirement accounts, and that's one of the things that we do in our retirement team action plan, is we look at taxes, estate planning, asset protection, and money management. And I would first say that we're not a CPA, we're not an accountant, we're not going to prepare people's taxes, but we're going to try to give you proactive advice by working with a CPA, working with a tax preparer to run the numbers. And before the end of the year gets here, because the clock is ticking, a lot of these things you want to implement, you know, before kind of year end. So when we're looking at retirement accounts, one of the things that a senior could do is they could consider relocating to a tax-free or tax-friendly state. You know, I love Northwest Ohio. I love the different seasons, but, you know, to be honest, I probably like snow just on Christmas and maybe one other day. Other than that, the, you know, darkness at night and the extended downturn of the cold weather does make some of these tax-friendly states more attractive for folks in retirement. And that's why you see so many people that are moving to those states. Number two is looking at Roth conversions. So with a Roth conversion, what you're doing is you're taking the money in the traditional tax-deferred retirement account, you're paying taxes in today's dollars, and you're converting that over to what could be potentially a tax-free account, not only for you, but for the next generation as well. You want to look at tax-efficient withdrawal strategies. We've talked several different times about this particular topic. I had a gentleman who had come into our office last week, and this gentleman was looking at his withdrawal strategies. His wife was a little bit younger than him, so she is currently getting her health insurance from the Affordable Care Act. Well, they have a credit on their taxes based upon what they estimate their reportable income is going to be in the year 2024. You know, one of the things that I caution them is, hey, make sure you watch out what your thresholds are of your income, because if you go over a certain income level for affordable health care, when you file your taxes next year, they could ask for that money back. So again, a tax efficient withdrawal strategy is a great idea in his particular situation. He may want to take more money out of his non-taxable retirement account and, you know, delay until his wife gets onto the Medicare age. What you want to do is you also want to fill up the tax brackets when you're looking at taking advantage of your situation. We have met with parents of our adult clients, and we look at the fact that they're forced to take required minimum distributions. And between that and Social Security, they oftentimes don't have much or any taxes that they owe. And then they have these large retirement balances that their desire is to pass that money on to the next generation, their children. Well, what they don't realize is that their children are not going to be able to inherit those retirement accounts in as a tax favorable way as what they could. What they may be better off doing now is taking advantage of the tax bracket that they're in, looking to pay some taxes now, especially if the desire is to move that money over in a legacy to the next generation by filling up those tax brackets. The other thing is for that older generation, for those of you that are over 70 and a half, and you're donating to a charity, make sure that you're aware of what some of the tax strategies are and what you can do with money over the age 70 and a half, and specifically talking about required minimum distributions. Oftentimes people will take their required minimum distributions. That's then going to be reportable taxable income on their tax return. They'll put the money in their checking and savings account, and then they'll write out a check to the charity. Well, it could be much more tax efficient if they wanted to donate to that charity, to donate directly from their IRA to the charity, thus keeping it off of their personal tax returns. Another area with end of the year coming up is looking at capital gains and tax loss harvesting. I had run into another situation for a gentleman quite a bit older, not the best health. And when I looked at his tax return, he had this large balance of a carry forward loss from an experience he had had in the past with some different investments that he worked with. And what I explained to him is I said, looking at your tax loss, you can only write off roughly $3,000 a year of that. But over here, you've got some of these other investments that have done really well. During your lifetime, you may not be able to write off all those losses. Instead, what you can do is you can take some of the gains to help accelerate getting rid of those carry forward losses. In addition to that, I have another client that we work with. We'll take a look at his portfolio, and every year we'll selectively pick out investments because he wants to try to get, some type of tax loss and be able to take advantage of that. For those of you that have non-retirement accounts, individual investment accounts, municipal bonds could be another category to take a look at. Now that interest rates are starting to change a little bit, bonds typically work inverse of interest rates. So as interest rates go down, bond prices can go up, and municipal bonds could be another way to get some tax advantaged income in some of those tax advantage accounts. If Scott was here, I know he's busy during this time period with helping people with their Medicare, but one of the things that Scott would talk about would be health savings account. While you're still working, putting as much money into building up that health savings account, you're going to need it down the road for, helping some of the healthcare costs that you have when you move into retirement time, all the way down to helping protect your assets from long-term care. And the final ninth idea that I would have about looking to think of reducing taxes in retirement time, thinking of your retirement as a business, is Social Security optimization. So another lifetime income source that is important on when you take that income. Getting offered the ability to take the income early, but at a reduced rate, may not be the best decision. If you look at your business and look at your retirement as a business, the best decision would be, how do you get as much income as possible into the business for as long as it lasts?
It's all encompassed in that retirement team action plan, taxes, estate planning, asset, money management. It's not just one of those things that's working for you or against you, but if you neglect one of them, it could make the whole thing fall apart. So start developing that strategy, especially as it pertains to, that business partner you have in Uncle Sam and buying him out as soon as possible. It all begins with the conversation. 419-794-3030. The website, arhq.com. After cutting interest rates by a half point, the Fed is expected to cut again at its meeting next month. Here's former Atlanta Fed President Dennis Lockhart on CNBC.
I think they've shifted from fighting inflation and being a little bit nervous about the employment situation to really protective mode. And the 50 basis point move, I think, was maybe just a little bit of a catch up from July and sort of a down payment for the beginning of this protective mode.
So speaking of protective mode, should retirement savers portfolios be in protective mode as well, with possible future market fluctuations on the way?
I think that a lot of that depends on where each person as an investor really is. So in my case, I've been investing for a long, long time. And as far as, do I have thoughts that I should be putting my money in protective mode? I would say no, because I still feel like, given the nature of Fed interest rate cuts, what that does to the market, combined with the historical performance of markets during a presidential election cycle, I think there's a lot of reason to be optimistic. But should a client be concerned with having what I would call circuit breakers on their portfolio? I do feel that makes a lot of sense. A circuit breaker operates that when certain indicators start to show drop, and I know unemployment is one of those indicators, inflation is an indicator. Those are the two major ones. If those numbers start to drop, then you will see portfolios with circuit breakers start to kick in and try to be ahead of a potential market loss in the event that the market gets jittery or we have a major correction. Are we in line for a correction? Yeah, we very well could be, because the last 2 years have been really, really good. But like I said, with cuts in interest rates on the horizon or continuing, and the fact that we're going to have a little more certainty in a month about who's running our government and what types of steps they're going to take politically, I think certainty is always good for financial markets. And so with that being said, protective mode comes, in my view, comes down to what each individual client feels about their current situation.
Yeah, I think a lot of that does come back into the phase of where you're at with the thousands of people who go and watch our YouTube channel. I know a large audience of that is people in their 30s, 40s, and 50s. And for those folks that are saving and investing in their retirement accounts, what happens next year or in the short term with the market fluctuations really has little to no impact on the long-term success of their plan. They want to be careful about trying to, time the market. Whereas I had a gentleman that had come into the office. What we did is we did the retirement team action plan. And on the M section of it, which is money management, we ran a stress test on his portfolio. And we measure risk in a portfolio from 0 to 100. And he had a risk level of 78, retired 2 years ago. So in the last 2 years, he's experienced great growth in his portfolio since he's retired. He's taking pretty substantial withdrawals from his retirement account to fund his lifestyle, which he should. You should enjoy the fruits of your labor. But when you look at the withdrawal rate that he's taking and the fact that he has an all equity portfolio, in his particular situation, the concern that I would have would be a sequence of return risk, meaning that, I'll give my outlook about the markets, Dave can, and our investment committee will, but the markets don't really care what our opinion is. The markets are going to do something, and it only takes a catastrophic or unexpected event to have the markets turn in a big hurry. And so markets can go down, and that's where you get a lot of the dangerous market fluctuations, especially for a retiree taking money off of their portfolio. In looking at history as a guideline, what we'd also have to do is take a look at the impact of what rate cuts kind of really can mean historically. I think, Dave, you pointed out pretty well, when the Fed is just acting in normal market conditions, which is kind of what we are now, they're saying, hey, we feel that we've got inflation more under control. We feel comfortable beginning to kind of slowly lower these rates to help create what's called this soft landing. That's different than maybe what we experience when interest rates are dropped dramatically during some economic crises that we've had in the past. So when you saw the dot-com crash of 2000 or the financial crisis of 2008, or even the response that we had of COVID in 2020 with rates coming down, again, it's a different environment than what we're currently in. And I'm not saying that something unexpected can't happen. That's why it's called unexpected. Markets can have a positive reaction. And the reason being is it's going to be lower borrowing cost. My interest rate that I get on my money market account is coming down. It's below 5%. So at some point, it might be more attractive to deploy that capital back to, equities as an example. Corporations can improve their profitability because their borrowing costs are lower, and it's going to help stimulate economic growth. So those rate cuts can actually be a positive thing. The most important thing here is, again, to know what your risk level is, to know what you want to accomplish with your goals, and to stress test your plan to make sure that it lines up to exactly what you want to do. That's what you should do when you're thinking about, do you be more protective in this environment today?
As it is right now, football season, I think a lot of things that we all like to see as fans of varying teams is, in that fourth quarter, having a substantial lead over your opponent, but then being able to go into that victory formation, that protective mode. And that's the same sort of thing that you kind of want to do as you get closer and closer to retirement. Hopefully, you've been able to reap the benefits of a very well-performing market these past few years. But as you get closer and closer, being a little bit more defensive-minded, not saying you take all the chips off the table. Maybe you do, depending on your risk tolerance and your comfort level. But finding that right blend, starting to switch into a little bit of protection because, as we know, the market's being fickle. We don't want a downturn to really jeopardize the overall quality of your retirement. Finding out how it's going to work for you, it's what the team at the Retirement Guys Formula and America's Medicare Associates can do for you. To get started with them, go to the website, arhq.com, or set up a time to speak with them by giving a call, 419-794-3030. The Fed cut interest rates a half point at its September meeting, which is a big reason why mortgage rates have gone from a 20-year high of 8% down to the 6% rate. Those rate cuts could create more home buyers. So what are some of the reasons that people might want to consider selling their home at retirement time?
Well, I just wrote another interesting article for the Toledo Free Press talking a little bit about the changes in interest rates. And if you want to get that, you can go to ToledoFreePress.com and click on the article that I put together talking a little bit about this. But when you look at it, there, I think, could be multiple reasons on why somebody would want to sell their home at retirement time. I have some clients that we've worked with for a long time, and their home, like many homes, really kind of appreciated a lot in price here recently. They wanted to be able to tap some of the home equity that they have to kind of fund their retirement goals. They wanted a little bit more income, and actually, some of the multiple desires that they had, like not having as big of a house that needed a lot of maintenance, made a lot of sense. So number one, looking at home equity to fund retirement. Downsizing, when you look at downsizing, the advantages that could be in that situation would be, one, looking at like reducing some of the expenses that you have. Property taxes. I don't know if you've got your letter yet, if you guys have, but I just got my letter from the Lucas County auditor, and my tax assessed value went up by over 30%, meaning that my tax rates, if I do nothing, are expected to go up by over 30%. And it's, a retiree, if you're on more of a fixed income budget, those type of expenses can be a real big challenge. As a side note, if you go onto the Lucas County auditor's website, you can file online to have your property value challenged and have the potential to have that reduced. But in addition to that, when you have a bigger property, you ultimately end up having more expenses with utilities and maintenance. I know a good example of that is Scott, who many of you listen to here on the show. His mother recently sold the property that they had. They had a great property, big pond, nice barn, big house. But, mom had sold her property to move a little bit closer to her son. Now she lives within walking distance of his house, and she has one of the newer condos. So not only was she able to reduce some of those expenses, the maintenance, utilities, she also has the advantages of a lifestyle change, being closer to family. There's a lot of value to that. Even with her big property, I know one of the challenges that they had was just the physical upkeep. When you think about, a big property and what it takes to maintain your landscape, your yard, some of the advantages of these maintenance-free living facilities, like what we have at Waterside or other communities, was even advantageous to my mom when she lived there. Just has to worry about the inside, not have to worry about the outside is really advantageous. We talked about lifestyle changes in one of our earlier segments, people who want the freedom to travel. Maybe they want to move to more of a tax-friendly state. They could look at selling their home, finding a place in a more tax-favorable state to do that as well. There can be some advantages from a Medicaid protection scenario. Years ago, I had met with a couple, and the husband was going to go into a nursing home facility. And under Medicaid, they had a large amount of their investment assets that could have been subject to a Medicaid spend down. They, like many of our listeners, had lived in the same house for 35 or 40 years. The house in the neighborhood that they lived in had changed a lot. I think about the first house that I bought in Toledo. It was over on Hoyles Avenue. Loved the neighborhood, loved it as a first house, but that neighborhood has changed a little bit nowadays. The same was true with the neighborhood that she lived in. Has kind of deteriorated. Not only is her property probably after 30 or 40 years going to need more work to it, she's able to take and use some of the money that they had saved up and be able to go purchase a new house and have something that is not going to have to worry about maintenance, gets her in an area that she wants to live in, probably in a situation of having a home that's going to be good for the rest of their lifetime. And from a Medicaid perspective, a husband and wife are able to have one house. So moving that money from what could be a countable category to a home, an uncountable category, could be another advantageous thing to do in a married situation. And why you should think about it now is home prices are really strong. And I look at the value of my house that I have. My wife and I have been in our house for 18 years now. And just even in the last couple of years, looking at what some of the values are going for is very advantageous on when to look to sell your home. That's part of, I think, some of the things that we do. If you're thinking about your home, you're thinking about what do I do? I think that's one of the other advantages of the team approach. And when we talk about a team, I think about the strong team of professionals that we have right here at America's Retirement Headquarters, but it also is regarding the team that we have here in the community. In that Toledo Free Press article that I wrote, I had an opportunity to review John Mangus from Remax Preferred and get his outlook in the real estate market. I had an opportunity to talk with Liz Terwilliger and as a mortgage broker, get her opinion about mortgage interest rates. And, when do you look at getting a mortgage interest rate? When do you look at refinancing? So that's just, again, one more advantage of working with us and our team is we can kind of help bring in these other professionals to help coordinate that situation. A lot of times people say, Nolan, well, if I sell my house, I'm going to have to go out and just buy something and it's going to cost me the same or more than what I have now. And if those are the type of issues that you're thinking about, that you're trying to work through, that, like any situation, is why having a good plan and having a good team in place will help you figure out if you should sell your home at retirement.
Whether it is in retirement or, at any point in life, the purchase of a home, the selling of a home, it's a pretty big deal. And it is something that, if it's something that you're considering when it comes to your retirement, it's worth making sure the numbers align, make sure those T's are crossed, those I's are dotted. The team at America's Retirement Headquarters, they can help you with that as it pertains to your retirement without jeopardizing the quality of your retirement, hopefully. But it all begins with reaching out to them. You can find out more about the people that work there, as well as a retirement team action plan at arhq.com, or you can give a call right now, 419-794-3030. One of America's most iconic brands for nearly 80 years has filed for bankruptcy. Tupperware is more than $1 billion with a B dollars in debt. And Duke University marketing professor Jamie Jones says the reason, well, it's rather simple.
The popularity of these products soared in the 1950s and 60s, where women would host Tupperware parties, gatherings that would showcase these airtight plastic containers, and they'd recruit their friends to do the exact same thing. Times changed, and Tupperware did not. E-commerce started booming, direct sales started declining, and yet Tupperware held strong, refusing to acknowledge the need to innovate and change. In fact, Tupperware remained so steadfast in sticking to their business model that they didn't enter major retail channels until 2022. That's 2 years ago.
I remember seeing Tupperware for sale inside a store. And I thought that was a strange thing and a sign of, what has come now. Much like Tupperware, there may be some worrying that their retirement plan is, that it's stuck in the past as well. How do you make sure that's not the case, that it does stay up to date?
I think it's extremely important to keep your retirement plan up to date, especially when it comes down to the technology changes that we're seeing in our industry. And I think about other companies that filed bankruptcy or got into trouble because they didn't keep up with the times. I mean, Kodak, right? They said everybody's going to always have a camera when they go to vacation and refuse to adapt to the markets and, Blockbuster Video. I can remember my wife and we would go there on Friday nights and we would pick out the videos that we want for the weekend and walk up and down the aisles. And I always ended up going back to the first one that I picked, but we'd always want to see what's available out there. Now I could just click on a button and watch any movie pretty much anytime that I want, just from the comfort of my couch. The same is true when we look at the retirement industry today, and it's so important to keep your plan up to date. It's one of the things that we've done here at America's Retirement Headquarters is try to invest heavily into technology. And if you think about technology, I mean, technology's come a long way in many different categories. Think about the improvements, say, in the healthcare field. Many of the diseases in the past, which you would consider to be a deadly diagnosis, are now more chronic illnesses that people can live with for quite some time. And in the world of investing, we've also got some dramatic improvements. The ability to go online and develop a financial plan for folks and be able to do that in a much shorter amount of time by aggregating all the accounts together, used to take hours and hours to do. When we look at things like some of the advisors that are able to give you automated investment advice, we have a software for folks that have 401ks, and we can take and look and program in their 401ks. And if and when economic conditions change, we can send them a push notification to their cell phone and or alert them by email that they need to log in and use one of the circuit breakers that we had talked about earlier to try to limit the losses in the portfolio, and or, when it's maybe time to rebalance or make a change. We think about things like developing the investment policy statement. With our software, instead of just asking an investor, are you conservative, moderate, or aggressive, we can use our software to really, pinpoint the outcomes that could be possible within a portfolio, and do that within about a 95% accuracy. And then also stress test a plan that says, what happens if it's one of those out of the norm type of environment? What is the maximum potential drawdown that you could face in your portfolio? And that is how it allows an investor to make much smarter decisions about how to position their portfolio. In my opinion, when you work with a financial professional, one of the common questions you're going to ask the professional is, what do you think the markets are going to do? And last week, we held our economic summit, and we talked a little bit about the markets this year. We talked a little bit about, our beliefs about where the markets are going to be. But the true value, I think, of working with a financial professional is to utilize the technology to keep your retirement plan up to date, to do everything they possibly can to optimize the portfolio, to make it customized to your unique situation, your individual goals and objectives, and then have a process that allows to monitor that plan. If I get my backup of my water and sewer at the house, if my sump pump goes out, an alarm goes off. It warns me. And that's something, in the past we didn't have. If we think about the car, I have had a Tesla, a self-driving vehicle, and about 95% of the time, the vehicle would just take care of driving itself. The same would be true. I have some classic cars, and I love some of my older vehicles as well. But the technology today can make things really better to help keep that retirement plan up to date. So if you're thinking about your situation, you're thinking about, how do you keep your plan up to date, or what is the company that you're working with, and or how is your current financial advisor keeping your plan up to date? And you think you need a second opinion, you want to say, hey, what else is out there? What do you guys do? That's where that retirement team action plan comes into play. We can run that analysis, give you that information, show you where your plan's up to date, show you maybe where there could be some opportunities for improvement, and or maybe some potential threats that you could be facing, so you know about those before something bad happens. Those are all the ways that companies like Tupperware or Kodak or Blockbuster Video should have been adaptive to the times, because in retirement, you only get one shot at it. Mm-hmm. You don't have the luxury like they do to file bankruptcy and hopefully come back in a new fashion. Nobody in retirement time wants to end up going back to work because they're forced to. That's why you've got to get it right the first time.
And we all know that change is inevitable. So when you start working on a retirement strategy and a retirement plan, you might be developing that plan with one set of parameters in front of you. And then 5 years down the road or 10 years down the road, something happens that forces you to have to change. And your approach with with how you're handling your retirement income situation. So having a qualified financial advisor is so important because it's really an ongoing dialogue that you're having with your advisor. They're listening to how your thoughts might be changing and are able to make pivots in the financial plan to help you get to where you want to be. Because I'll tell you what, I don't know about you, but if I have to call XYZ retirement plan to sell investments, I don't know many people who realize how they actually would go about doing that. So by having a person from the America's Retirement Headquarters work with you, you've got that strength lined up. If changes need to be made, we can handle it for you. And when things need to pivot in your planning process, we can handle that as well. So that's why you need to meet with us.
And a retirement plan doesn't have to be set in the 90s like Blockbuster or, the 80s or even the 50s like Tupperware. Even if it hasn't been looked at or really thoroughly reviewed in just the past couple of years, a lot of advances in technology is certainly worth doing. That is the power of a second opinion. You may find out that you're actually in pretty good shape right now, or you may find out there's opportunities out there, or, worst case, that there's a lot of work that needs to be done, but then now you'll know how to go about doing it. But it all starts by reaching out to a team like the team at America's Retirement Headquarters. 419-794-3030 is how you get started. You can also find out more about the team, set up a time to speak with them as well on the website, and that is arhq.com. What happens to your 401ks when people retire? Well, according to a recent study by Vanguard, within 5 years, half of the people, a little over half, roll over the money into their own IRA. Another third cash them out. Only 17% stay in the plan. So how are they doing here? What are the ups and downs of keeping your money with your current 401k provider while in retirement?
There are a couple of different options of people when they retire on what to do with their 401k. Number one is to leave it in their 401k. Maybe if they're changing jobs, they're going to maybe more of a part-time. They could transfer it over to the new company 401k. They could take number three and they could cash out the 401k. Or number four, as mentioned there, about half of them ultimately convert and roll that over into their own IRA. When you look at it, I think there's pros and cons to each of those options. When you look at a 401k, dependent upon the size of the 401k company, in some of the 401ks that are out there for people that like to either manage their own money or people that are comfortable with their options, you could end up in a situation where you have lower fees. A lot of the times, even our firm, has assets under management type fees. Some of the fees and expenses can be lower by leaving the money in the 401k plan. Some of the plans have what's called a self-directed brokerage options that allows you to maybe pick out some individual choices if they don't have some of the plan choices that you're comfortable with. Leaving your money in your plan can help you with also creditor protection. I've seen people in situations, one of the examples there was people cashing out their plan. And, I don't know necessarily in that survey the reason why, but if they were, cashing out their plan to pay off a creditor, it might have been better off to take advantage of some of the ERISA protection in the 401k by leaving that money in the retirement account and not cashing it out. Of course, you get some benefits where you're not forced to take required minimum distributions in a 401k, especially if you continue working past the age 73. You may delay some of those required minimum distributions until you fully retire. Some of the plan-specific details that are out there, they might have some advantages to financial planning services, retirement income tools, low-cost loans if you're still working there. In most IRAs, you're not going to have the ability where you can take out a loan against an IRA. Again, some of the ease of management, you might be familiar with that platform. Maybe you've had that same platform of managing your money, for quite some time. And again, you're looking for ways to continue to grow that money. taking the money and cashing it out, which is what some of the people had done in that survey. It said about a third of those people cashed them out. I generally think that's usually a terrible idea. The reason being is you get all of that money paid out in 1 year in a large tax. And so if you're thinking about, blowing your retirement account, cashing it out can be an absolute way to do that. The other, roughly half of the people, so 52% in this survey, rolled over the money into an IRA. The advantage of the IRA is it allows you to have a completely customized plan. There's going to be different investment choices and options in an IRA that you don't traditionally have in most 401ks. An example that I would say is, we talk a lot about people wanting to have reliable income in retirement. And when we think about reliable income, we think about pensions, we think about Social Securities, but annuities for hundreds of years have been a vehicle utilized to provide reliable income. And most 401ks don't have an annuity option available. Taking some of that money and moving it to like a self-directed IRA could open up those options. Your plan maybe doesn't allow for your ability to look at self-directed investments and buying like individual stocks. We have a very defined investment methodology and philosophy when it comes to picking stocks within a portfolio. And most 401ks in the marketplace don't allow the plan participant, aka the account owner, to go and purchase, individual holdings on what they want to have within the portfolio. You can, again, create a spectrum of different investments. You can buy things that are designed to give you a future pay raise. You can get involved in some of the alternatives that are become more popular, like cryptocurrency. If you wanted to have, a small percentage of your portfolio in something that you thought was going to really be a big and change in the future, adding that in there as well. So the IRA is going to ultimately give the individual retirement account owner more control over their choices. But again, you just got to weigh the different pros and cons is what I would tell people.
I'll look at this in a little different view. So over 23 years doing this, I've had a lot of discussions. I've had countless discussions with people who are working and participating in their company's 401k. And I remember asking almost all of them, how did you come to pick the investments that you have in your 401k? And they said, well, I printed off the laundry list of funds that the plan offered, and I looked at which ones did the best, and that's where I placed my money. Well, in a way, those folks were chasing returns. Mm-hmm. So just because it was good in the past doesn't necessarily mean it's going to be good for the foreseeable future. When a person is considering whether to leave money in the plan or create a rollover account, I guess the thing I would say is, do you want a finite list of funds, or do you want to have basically an open scenario where you can pick if you want stocks, if you want but you actually have a greater universe of investments to choose from when you create the private IRA. Yes, if you hire a financial advisor, there will be fees and costs that get associated with that. But with that, you're also getting planning services. You have a live voice that you can talk to when you pick up the phone and call them. You have ongoing reviews. You have all of the advantages.
I've recently heard a 401k be equated to, you're in a supermarket and you go shopping, but with the 401k, you've got access to one shelf on one particular aisle. The rest of it is kind of off limits. That is where you get limited with the selections that you have. Now, as you get closer and closer towards retirement, if you have the options of a self-directed IRA or things like that, suddenly the whole store is available to you. Could be daunting, could be intimidating. Perhaps you still like the stuff that's on that aisle. That is okay. But knowing what your options are, being able to explore them, I think is worth taking a look at. And that is something that the team at America's Retirement Headquarters can help you with. your own personal shoppers, I guess, in that regard. But it all starts with setting up a time to speak with them, whether it is attending events that they've got going on. You can go to arhq.com, click on the events tab for that, find out more about the team, or set up a time, skip the line, and come in and speak with them directly. Give a call, 419-794-3030. Once again, that's 419-794-3030. As always, want to thank you for joining us here on the show, spending time with us here on America's Retirement Headquarters. Hope you have a great week ahead of you. Gentlemen, always grateful for the time. Hope you have a great week ahead as well. And as we wrap up, I do want to leave you with the final word.
We are a comprehensive financial services company, and we can take care of whatever your needs are, either in the planning or in the investment management or all of the above.
As always, just when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.